our main focus point is about top recession-proof investments to protect and grow your portfolio. The first thing you have to understand about a potential recession, which, like I said at the top of the show, we probably get one, say in this Trump presidency, right? We're in the latter stages, most likely 8th inning. I call it top of the 8th. This is probably where we're at if I'm going to pinpoint it, right? More time on the clock, but we're in the latter innings. Now, the first thing you have to understand about a recession is that not all of them mean a major decline in the stock market. In fact, 5 of the 11 recessions in the U.S. economy since 1950 showed positive stock returns. Did you know that? 5 of the 11. So don't presume that just because we have a recession that you have to see major equity losses. Now, usually there are sectors that do very poorly, others do well, and you can still have a market that rises, right? So the big question is, in this market, is what happens with tech, right? Because it's such a heavily weighted part of the market these days, especially the indexes. Now, historically, though, there are certain sectors that hold up well, or say asset classes that hold up well, that tend to thrive in a recession. Let's just say that. Now, the first one is obviously gold, and we're already seeing it thrive, up 30+% year to date, where the S&P is only up around 8%. And so it's a hedge against both geopolitical and economic risks. And you're already seeing other tailwinds as well, like central banks around the world buying more and more. In fact, the World Gold Council survey shows 43% of central banks plan to increase their reserves in gold in the coming year. That's up from 29% last year. So in many ways, gold is the international currency. Okay. So that's number one, and I think everybody needs to have some exposure there. Number two, U.S. Treasury bonds. Now, the big question here in this environment is, what type of U.S. Treasury bonds? Historically, longer-term Treasury bonds have been a good thing, right? Rates have fallen, especially since the early 80s. During recession, rates have fallen, and that has made longer-term Treasuries a smart way to go. However, in this environment, if it's a more inflationary recession, and I could see that as well, right? If inflation continues to climb into the 3s, maybe into the 4s, and you get an economy nominally that now dips below that number, your real growth is negative. Nominally, you're still going up, and that's one of the reasons why a lot of recessions, you still get equities going up, because earnings are priced nominally. They're not priced in real terms, right? So if nominal growth of the economy is still going up, but inflation is now higher, now sort of 2 quarters in a row, you get some sort of sell-off in the credit markets to where there's tougher economic times in general. That is a recession, okay? And so I think that's more likely what we're seeing going forward. A lot of people think of a recession, they think 08. 08 was a financial crisis, very different. Most recessions are similar to the 2000 to 2003 recession, or in that period. It's called the 2002 recession, I think was the official time when we went into a recession. And then, you go back to the early 90s because the 91 recession. Those are more typical recessions, okay? And that's most likely what will happen in the future. So Treasury bonds, but in this environment, I would say shorter duration. Okay. Then there's dividend-paying stocks. Now, dividend-paying stocks typically have stronger balance sheets, steadier cash flows, but you don't want to buy any dividend-paying stock. You definitely want to focus more on sectors that are non-cyclical, and that's where you get into the next one, which is defensive sectors. So your typical defensives are utilities, staples, healthcare. You could say some parts of technology as well that are the business is very sticky, that isn't predicated on advertising, for example. I would think Apple is becoming more of a defensive tech because the iPhone is so integral. You're going to have an iPhone no matter what. You might slow your upgrade cycle, but if your iPhone breaks, you're probably still buying a new iPhone, whether times are good or not, that type of thing. So I would say defensive sectors, but also defensive companies, right? Companies that are less cyclical. So there are retailers that are very cyclical that sell maybe electronics that that you don't need to buy in a recession for the most part, versus certain retailers that sell a lot of toothpaste and shampoo and toilet paper, etc. Those would be more recession proof. So it depends on the company, really. And then there's high quality corporate bonds. You're talking the corporate balance sheets, especially for public companies these days, they're pretty good. So buying corporates, getting a little better yield, that can be a good defensive allocation as well. And then lastly, REITs. REITs can be a good place to be. They pay consistent dividends. A lot of times their rents are steady no matter the economic times. Depends on the type of REIT they are. Is it an apartment REIT, a healthcare REIT, warehouse, etc. Obviously, a healthcare REIT is going to be stickier than a warehouse REIT and steadier than a warehouse REIT. So make sure you understand that difference between the different REITs. And then obviously, cash can be a good place to hide for part of the portfolio, but you don't want to stay there for very long.